In this second lecture, we'll be discussing notes payable. In some cases, a note payable is going to result because a company borrows money from a bank. A short-term note payable is going to be a liability with a term of less than 12 months, and short-term notes payable are always going to be classified as current liabilities. The company could also borrow money for a period longer than a year, and in the 12-month period when that loan is due, it would be classified as a current liability. So the difference between accounts payable and notes payable is that notes payable are typically going to be interest-bearing, and they're going to be evidenced by a legal document known as a promissory note. They're considered a more formal legal obligation, so if a company goes bankrupt, the notes payable will get paid off before the accounts payable. So here's our example. We've got on May 1 of 2023, McLean Company borrows $20,000 from First Bank by issuing a 10% 3-month note payable. So our term is 3 months, our annual interest rate is 10%, and the face amount of the note is $20,000. At the point that we record the note on May 1 of 2023, we're going to record that we have cash of $20,000 and we now owe $20,000. We don't do any entry with regard to interest because at this point we just borrowed the money and we haven't incurred any interest expense. We incur interest expense with the passage of time. But we can calculate the total amount of interest that McLean will pay on the note. Interest is calculated as principal times rate times time. The principal or the face amount of the note here is $20,000. Interest rates by law have to be expressed as annual interest rates, so our annual interest rate is 10%. If we wanted the interest for an entire year, we would just say 20,000 times 10%, but because this is a 3-month note, we're going to say 3 over 12. 3 months over 12 months because we have a 3-month term and there are 12 months in a year. So we're basically prorating the interest using that annual interest rate. And so the total amount of interest is going to be $500. So 3 months later when the note matures, we are going to be paying out $20,500. We'll be paying off the face amount of the loan of $20,000. We will have incurred $500 worth of interest expense, and the maturity value of the note is $20,500. Maturity value refers to the amount that we pay at maturity, and it's going to include the face amount of the note plus the total amount of interest. In other cases, we may issue a note payable in exchange for an accounts payable. So for example, if we have purchased goods or services on account, which are usually very short term, like less than 30 days, and we get to the end of the 30 days and we want an extension, they may be willing to give us an extension if we sign a note payable and pay interest. So our example here is on November 1, 2023, Frampton Company asked Brandy Company to replace its past due account with a note payable. Brandy agrees to accept a 6-month $10,000 14% note payable. So Frampton's entry is going to be to take their accounts payable off the books and bring a note payable on. Recall that accounts payable and notes payable are both increased by credits, decreased by debits. So when we debit accounts payable here, we're removing the accounts payable from the books. You can see that posted in the T account, and then we are increasing our notes payable account. So we have exchanged one liability for another. So the total amount of interest that Frampton is going to pay here is going to be the face amount of the note, $10,000, times the annual interest rate of 14%. And here we have a 6-month term, so we're going to multiply that times 6 over 12 and get $700. One of the things we want to note here is that we're assuming that Frampton Company has a December 31 year end. That is going to be the assumption that you'll make unless you're told otherwise. So it's a 6-month note, but 2 of those months, November and December, fall in 2023, and the other 4 months, January, February, March, and April, fall in 2024. So they are going to incur 2 months worth of interest expense in 2023 and 4 months worth of interest expense in 2024. So of the $700 in total interest, 233 of it is a 2023 expense. That is computed by saying 10,000 times 14% times 2 over 12. And we're saying 2 over 12 there because November and December, 2 of the months in the term of the note, fall in 2023. The other $467 of interest are incurred in 2024. So we're saying 10,000 times 14% times 4 over 12 because 4 of the months of the term of the note fall in 2024. So because the note covers 2 years, we're going to need to make an adjusting entry to accrue interest at 12/31/2023. So we borrowed the money on November 1. 2 months have passed. We owe 2 months worth of interest expense. So we're going to debit interest expense and credit interest payable for 233. So now we have 2 current liabilities that will be reported at the end of 2023, a note payable for $10,000 and interest payable of $233. Interest expense of $233 will also be reported on our 2023 income statement in other expenses and losses. On the maturity date on May 1, we're going to be paying out cash of $10,700. That's our maturity value, and it's equal to the face amount of the note plus the total amount of interest. For the 2023 interest, we accrued it at the end of the year and recorded a liability for interest payable. So in our journal entry, we're going to need to take the note payable off our books for $10,000, the interest payable off our books for $233, and then record the interest expense for 2024, which we calculated as being $467.